Welcome to this explainer. Okay, today we are going to completely demystify retirement by looking at a surprisingly straightforward blueprint. I mean, if you've ever felt like retiring early, or honestly, retiring at all, is just one of those things that happens to other people, well, you're in exactly the right place. We're going to explore exactly how you can reach that ultimate retirement finish line, starting from absolutely zero, using just 3 specific Fidelity index funds. But before we get too far ahead of ourselves, we've got to tackle a seemingly impossible question to start things off. How much do you actually need to invest every single day to make retirement a reality in just 10 years? When you ask people this, most guess way, way off. Some guess way too high, thinking it requires literal lottery-level luck, and some guess way too low. By the end of this explainer, I promise I'm going to reveal the exact daily dollar amount to you, and it's the kind of number that completely changes how you think about almost every other financial decision you make. Okay, let's dive right into this. Because before we can even talk about those daily contributions, we need to anchor ourselves to a specific destination: $1 million. It's the universal retirement number, right? The golden benchmark everyone always talks about. We're going to map out 3 completely different ways to get to this exact same finish line. But you might be wondering, why 1 million? What does $1 million actually do for someone once they finally get there? To answer that, we're leaning on a rock-solid retirement strategy backed by decades of research called the 4% rule. The mechanics here are beautifully simple. If you have $1 million invested in a broad index fund portfolio, you can withdraw 4% of it in your first year of retirement. That is $40,000. Money you literally didn't have to work for. The next year, you just adjust slightly up for inflation and you do it again. The reason you can do this without draining your account down to zero is because the stock market typically grows faster than that 4% withdrawal rate. So while you pull out cash to live on, the principal usually stays totally intact, just growing in the background. It's like magic, but it's math. Let's actually walk through the math here to prove just how life-changing this destination really is. That $40,000 a year breaks down to $3,333 going straight into your bank account every single month, whether you clock into a job or not. Now, if you add an average Social Security check on top of that, which is, about $2,076 a month right now, you are looking at over $5,400 in total monthly retirement income. That is a solid, completely livable wage generated entirely by your portfolio and the system. So the destination is clear. Now, how the heck do we get there? All right, section 1, the engine. 3 core Fidelity funds. Now, what's really interesting about this is the how. The how of this whole strategy depends entirely on the tools we use to reach that $1 million target, starting from absolutely zero. No matter which timeline we look at today, the engine under the hood remains exactly the same. Notice the clear staircase of risk and reward here. You can see how these 3 funds stack up over the last 10 years based on their average annual returns. We've got our reliable baseline, our growth bridge, and our aggressive high flyer. Let's quickly break down exactly what each of these acronyms actually means. First up, we've got FXAIX, which is the Fidelity 500 Index Fund. Honestly, think of this as the biggest, most boring fund in your portfolio, and that is exactly why it works so incredibly well. It tracks the S&P 500, so the 500 largest companies in the US. When you buy this, you're basically buying a massive, stable slice of the American economy. Plus, it has an expense ratio of just 0.02%, which is about as close to free as investing gets. And it's averaged roughly 12.97% annual returns over the last decade. This right here is our rock-solid foundation. Next in the lineup is FNCMX, the Fidelity NASDAQ Composite. This one acts as our growth tilter. So instead of the S&P 500, it tracks the entire NASDAQ, which means it leans much, much heavier on technology and biotech. These are the kinds of companies that grow faster but also swing a lot harder when the market moves. With a 10-year average of 16.91%, it offers you higher reward, but yeah, with higher volatility. It's the perfect bridge between safe and aggressive. And finally, we have FSELX, the Fidelity Select Semiconductors portfolio. Now this one is our wild card. It only invests in the chip makers behind every phone, laptop, and AI model you use. Over the last 10 years, it has averaged a staggering 22.04% return. But hey, be warned, semiconductors are highly, highly cyclical. When they crash hard. But as you'll see in a minute, for the right portfolio on a tight timeline, this fund is the secret engine that actually makes early retirement mathematically possible. Moving on to section 2, the 30-year plan, letting math do the work. So when you have 3 whole decades on your side, Time is absolutely your greatest asset, and the math just does the heavy lifting for you. This means the portfolio itself doesn't actually need to take on a massive amount of risk. Look at how this allocation breaks down. A full 60% is sitting right there in the safe, broad market of the S&P 500. Another 30% is in the NASDAQ, and just a tiny little 10% sliver is in those risky semiconductors. The broad market is doing all the heavy lifting here, with the semiconductors just providing a nice small kick of upside. Blended all together, this portfolio yields a highly reliable 15% annual share price appreciation. So what does it actually cost to fuel this 30-year machine? $6 a day. That's it. Literally, for the cost of a daily coffee and a bagel, you can fund your entire retirement. By year 30, that $6 daily habit grows into an unbelievable $1,004,150. And remember, once you hit that million, it starts paying you over $3,300 a month for the rest of your life, all from a daily contribution that's roughly the price of breakfast. Pretty wild, right? All right, Section 3, the 20-year plan, shrinking the runway. Now, let's be real, most people don't actually have 30 years to just sit back and wait, right? Life happens. Or maybe you're just starting a bit later. Well, when we cut compounding's runway by a whole decade, the workload of the portfolio has to shift to reach that exact same million-dollar destination in less time. The safe S&P 500 slice drops from 60% down to 35%, and the NASDAQ moves up to 40%. And look at our wild card. The semiconductors more than double, jumping from 10% to 25%. Because we have less time, these aggressive funds are literally forced to step up and take over the heavy lifting to deliver a higher appreciation rate of almost 17%. But, taking back a whole decade of time, that isn't free. The daily cost jumps up to $22 a day. That's about $660 a month. Now, obviously, this requires real discipline, but it is still super doable for a lot of people. It might just mean skipping a few restaurant meals, maybe downsizing a car payment, or canceling those streaming subscriptions you literally never use. It demands focus, sure, but in exactly 20 years, it lands you right at $1,040,920. Which brings us to Section 4, the 10-year plan, the concentrated bet. Okay, now we arrive at the timeline you are probably most curious about, turning $0 into $1 million in just a single decade. But hey, I want to be completely transparent with you. This is the absolute most aggressive version of our strategy. It requires intense concentration, and frankly, it's just not going to be for everyone. Here's the math behind a 10-year retirement. The broad market S&P 500 shrinks all the way down to a mere 15% because it simply cannot deliver the explosive growth needed inside a single decade. Instead, we see a massive 50% slice dedicated entirely to semiconductors. Half the portfolio is a concentrated bet on hypergrowth, driving the overall appreciation up to nearly 19%. And here's the climactic daily number we've been building up to: $120 a day. That is roughly $43,800 a year, or $3,650 every single month for 10 years straight. Realistically, to pull this off without, starving, this demands a household income of around $120,000 a year. If that isn't your reality right now, that is completely fine. The 20 or 30-year plans are your mathematical realities. But for those who can swing $120 a day, you will cross the finish line with $1,083,630 in exactly 10 years. No joke. Finally, Section 5, the price of time, compounding's cost. So the crucial point is, while the mechanics of these funds are super fascinating, what this truly reveals is the actual price of your time. All three of these plans land at the exact same $1 million destination, but the journey, and specifically who is actually paying for that journey, changes drastically depending on the runway you provide for compounding to do its job. Let's contrast your money with the market's money. In the 30-year plan, you only contribute about $65,700 out of pocket. The market generates over $938,000 for you. But look at the 10-year plan. You have to write checks totaling $438,000. You are almost matching the market's growth dollar for dollar. The shorter your runway, the more of the final million has to be funded straight out of your own pocket. And this brilliantly illustrates the true cost of time. It really comes down to this. For every single dollar you invest on the 30-year timeline, the market gives you a massive $14 back. Over 20 years, that shrinks to $5.50. And if you force the timeline down to just 10 years, well, the market only has time to give you a measly $1.50 for every dollar you put in. Time is literally the cheapest source of retirement money there is. Which leaves us with this final provocative thought. Time isn't free, but all these paths effectively lead to the exact same $1 million destination and that same $5,400 monthly income. The math works, the index funds are right there waiting for you. The only real question left for you to answer is, what price are you willing to pay and which plan can you realistically live with? Keep learning, keep planning, and I'll see you in the next explainer.